Welcome to Treasury One's weekly market review. Now, after months of loud hoo-ha, delegates have finally arrived for the 2023 Brics summit. Topping the discussions will be Brics expansion, the development of a new common currency, the war in Ukraine, as well as global food security. But it remains to be seen if any material policies will actually be adopted. Now, the C in Brics is having a bit of a tough time. The crash in China's property market has highlighted the country's sluggish economic performance. Now, troubles in the market have been brewing for some time, and there are those who suggest the downturn is actually being fanned by China's plateauing population. And with the numbers set to decline over the next few years, it could spell trouble for the other sectors as well. But for now, authorities are just trying to deal with the problem at hand. And on Monday morning, we saw the Chinese banks deciding not to pass on the central bank's August rate cut in their loan prime rate quotes. So they kept the 5-year rate unchanged while cutting the 1-year loan prime rate by only 10 basis points. That's versus the central bank's 15 basis point cut. You get the sense that Chinese authorities are walking a tightrope between currency vulnerability and economic weakness. The smaller cuts could also suggest that the authorities are perhaps waiting on other measures to kick in and support the economy. But the PBOC will have to continue cutting rates and reserve requirements to prevent a deeper downturn in the property market that could ripple across the rest of the economy. Meanwhile, over in the UK, July's inflation figures released last week remains too hot for the rates to be cut anytime soon. And in fact, the derivatives market is pricing in 100% chance of a 25 basis point hike in September and another in November. Then over in the EU, the 20 countries in the bloc recorded a 0.3% growth rate in the second quarter. But the outlook remains relatively weak. But this tad bit of resilience still in the economy could provide the space for the central bank to maintain a more hawkish posture. As for the currency, the ZAR's had a tough start to the week alongside most higher risk assets, and the pressure stems from rising US Treasury yields. It's fanned by America's fiscal concerns, and that is supporting the US dollar. Now, there are a couple of events which has market moving potential this week. Locally, we'll be tracking July's CPI data out on Wednesday, and we're expecting inflation to come down on the back of lower fuel prices, but inflationary pressures continue to hover on the horizon. It's due to a weaker currency, rising oil prices, and of course load shedding. Then towards the back end of the week, the Fed will host its annual Jackson Hole Symposium, where Chairman Powell is said to provide fresh clues into prospective monetary policy. And while price pressures have eased somewhat in the US, consumer spending and the labor market have remained robust. So we're expecting the Fed to stick with its hawkish undertone at this week's event. A string of PMI data out of the world's major economies will also provide a fresh perspective on the global growth momentum as we reach the midpoint of the third quarter. We're expecting economic sentiment to remain weak as the global rate hike cycle continues to filter through the real economy. That then the week that was and the one to come for the markets.